All right, let's dive into the world of Benjamin Graham. Now, when you hear that name, you probably think father of value investing.
Yeah, that's the one.
Maybe phrases like intrinsic value or the margin of safety pop into your head. His influence is just, well, it's foundational, isn't it?
It absolutely is. I mean, his books, Security Analysis, The Intelligent Investor, they're basically required reading for a reason. But like you said, those catchphrases, they're really just scratching the surface.
Right. So our mission today, pulling from this stack of sources we've got here, is to go beyond just the famous quotes. We really want to unpack Graham's operational system.
Okay.
What was that unique psychological setup? The intellectual architecture.
Sure.
The how. How did he actually manage to consistently act on his principles, especially when the market was, well, completely chaotic and everyone else was just reacting?
We're sort of looking for the engine room then, how he translated that whole philosophy into like unwavering, disciplined action, even when things got really tough.
Exactly. And for you, listening in, think of this deep dive as a bit of a shortcut.
Mm-hmm.
We're going to try and pull out the most crucial bits of knowledge, the key insights from these sources.
Mm-hmm.
So you can really grasp the core of his genius, understand how his system actually worked, see where maybe it hit some limits today, and maybe most importantly, figure out the single most powerful lesson you can take away for your own investing right now.
Yeah, it's about building a framework for thinking, for acting, not just, running numbers.
It's about creating your own defense against, well, the market's madness, maybe.
Yeah, that's a good way to put it. Building resilience.
Okay, let's start there. Let's explore that core edge he had. Graham's reputation, it's solid, undeniable. But our sources suggest his real alpha. That edge he had, it wasn't just from being brilliant at quantitative screening. Lots of analysts can crunch numbers.
Right, that's not unique.
So what was the real differentiator? What truly set him apart?
Well, the core idea, the thesis that really comes through from these sources, is that Graham's lasting advantage came less from, say, finding totally obscure companies nobody knew about,
Okay.
and more from a really profound, almost stoic kind of detachment, a detachment from all the market manias and panics. And this detachment, that was the key. It let him systematically exploit the collective psychology of other investors.
So it wasn't just finding the value, it was having the discipline to act totally differently from the crowd.
Precisely. His operating system, as we're calling it, was fundamentally built on applying the margin of safety principle, really rigorously, almost religiously.
Wow.
He didn't just see it as like a cushion if his analysis was a bit off. It was also an operational buffer against his own emotional impulses.
The emotional regulation part. That feels incredibly relevant right now.
It absolutely is. His genius wasn't necessarily getting some secret information nobody else had. It was having a superior reaction function to the same information everyone else had. But that information was being twisted, distorted by the market's emotional lens. His real advantage was having the conviction, the emotional fortitude to actually buy when everyone else was frozen with fear, or maybe sell when greed was just running rampant.
So it was about having the guts, and I guess the framework, to actually do what the analysis said, not just know what it said.
Exactly.
And this idea of building a system, writing it all down in security analysis, the intelligent investor, that was part of creating this repeatable approach, making it something others could maybe follow.
Yes, absolutely. Those books, they were a really explicit attempt to create a replicable system for rational investment behavior. Think of them like a cognitive toolkit, right?
Yeah.
Specifically designed to fight against emotional decision-making. And that devastating experience of the 1929 crash, he lost almost everything, that undoubtedly fueled this intense drive he had to build something robust, something that could actually survive market extremes.
He saw the chaos and thought, okay, I need a process, something to stop this happening again.
Exactly that. By meticulously defining core terms like investment versus speculation, by giving really clear, unambiguous criteria, and by creating these powerful metaphors like Mr. Market, he wasn't just sharing wisdom, he was actually building a shareable defense mechanism. A defense against all those psychological traps he'd seen and, frankly, experienced himself. He wasn't just an investor, he was fundamentally a system builder. He was professionalizing security analysis, turning it into a real discipline.
Okay, so why does this matter for you listening right now? Why should you care about his system building?
Well, in today's markets, I mean, they're absolutely saturated with noise, right? Fast information, volatile sentiment, understanding how someone like Graham built a system to stay disciplined,
Yeah.
to counteract his own human biases and the biases of the crowd.
Yeah.
That's invaluable. It gives you a powerful blueprint, maybe, for how you can try to act rationally in what often feels like a pretty irrational world.
Okay, so if that's the core edge, this disciplined, emotionally detached approach, what were the specific bits? Let's get into the nuts and bolts. What were the foundational pillars of this operating system?
Right. Pillar number 1, the worldview. This was his, deeply ingrained, almost philosophical lens, how he saw the market.
And what were the absolute non-negotiables in this worldview?
Okay, first, his view of markets as a manic depressive partner. This is, famously captured by the Mr. Market story.
Right.
Mr. Market shows up every day. He's willing to trade with you at whatever price he suggests. But he's emotionally unstable. His prices are often completely irrational, totally disconnected from the real value of the underlying business.
So it's like having a business partner who's just wildly unpredictable, shouting random prices based purely on his mood that morning.
Exactly. And Graham's core insight here was that the intelligent investor shouldn't listen to Mr. Market's moods, shouldn't be directed by them, you should use them. You buy from Mr. Market when he's miserable and selling cheap, and maybe you sell to him when he's irrationally exuberant. This fundamentally frames the market not as some perfectly efficient machine, but as something frequently irrational. And that irrationality creates opportunities for the disciplined observer.
And that perspective, it leads straight to the most famous distinction he made, right?
Yes, absolutely. The critical distinction between intrinsic value and price. Intrinsic value, that's the objective worth of a security. It's based on verifiable facts about the business, its assets, its earning power, dividends, long-term prospects, all that.
Okay.
The market price, though, that's just what someone's willing to pay today. And it's swayed by whatever sentiment is dominant right now. Graham famously said the market is like a voting machine in the short term, driven by popularity contests. But ultimately, it's a weighing machine in the long term.
Where the real value eventually shows up.
Exactly. The business's true value asserts itself. This core belief that price can, and often does, deviate significantly from value. That's the absolute bedrock of value investing. I mean, without that potential gap, there's no bargain to find, right?
Yeah, you have to believe the market isn't always right just to even start looking for value.
Precisely. And the third pillar of his worldview, this one was deeply personal for him. Capital preservation is paramount. Graham famously defined an investment operation. He said it's one that promises safety of principal and a satisfactory return.
Safety first.
Absolutely. Anything else, anything that doesn't prioritize protecting your initial capital. Well, that's speculation.
And this wasn't just some abstract theory for him, was it? It came from hard experience.
Oh, definitely not theory. Losing his father young, seeing his mother lose money in bad speculations, and then the 1929 crash. It nearly wiped him out, personally and professionally. Those experiences, they instilled in him this fierce urgency, as one source puts it, to invent a safer style of investing. For him, investment is most intelligent when it is most businesslike, which means you should approach it with the same seriousness, the same rigorous analysis you'd use if you were buying an entire private business. Focus systematically on minimizing the chance of a big loss. This unwavering focus on risk management, it's woven into absolutely everything he did.
So a worldview really forged in the fire of market volatility.
Yeah.
Prioritizing protection above everything else. That framework seems essential for navigating the ups and downs.
It gives you that crucial mental map, yeah.
Okay, let's move to pillar 2 then, the non-negotiable filters. If the worldview is the lens, these are the specific criteria, the quantitative rules that an investment absolutely had to pass.
Right. Graham laid out several quantifiable filters, clear checklists. Now, the exact numbers, they varied a bit depending on whether you were a defensive or an enterprising investor.
Okay.
But the core principles, they stayed the same.
And the absolute cornerstone of these filters must be
the significant margin of safety. No question. This is the principle, buy something worth $1, but only pay 50 cents for it. Conservatively estimated, of course.
Right.
It's not just a nice to have. For Graham, it was the primary tool for managing risk and the engine that actually drove his excess returns. This margin, it gives you a crucial buffer against bad news, unexpected negative stuff, and importantly, against making mistakes in your own analysis, which happens.
Of course. How did that actually look in terms of specific numbers or tests he used?
Well, primarily, it showed up as needing a price significantly below a conservatively calculated intrinsic value. And this led to specific metrics. For a defensive investor, he suggested, for example, a price-to-earnings ratio PE not higher than 15 times.
So how much you pay for each dollar of profit.
Exactly. And a price-to-book ratio PB, the market value versus the company's net assets, not exceeding 1.5 times. He also sometimes suggested the product of those two shouldn't be more than 22.5.
That PE times PB thing.
Yeah, the Graham number concept, basically. And some sources even mention stricter criteria he sometimes used, like a PE below 9 and a PB below 1.2.
Those numbers, they seem really low compared to today's market, don't they?
They certainly do. And a particularly powerful application of this margin of safety idea, one he really favored later in his career, was investing in net working capital stocks.
Ah, the cigar butts.
That's them. The idea of buying a company for less than the value of its easily sellable assets.
Yeah, less than its quick assets.
Exactly. It involves buying companies for less than their net current asset value. So you calculate this by taking current assets like cash, accounts receivable, but maybe only count 75% of that, inventory, maybe count only 50% of that, and then you subtract all liabilities, not just short-term, but long-term debt too, everything.
Correct.
He found this approach so reliably profitable, apparently, that sometimes he focused almost entirely on it. He usually recommended buying these stocks at a price no more than 2/3 of that calculated net current asset value, or NCAV.
So you're essentially getting the actual business operations for free, or maybe even less than free, and the value is protected by assets you could quickly turn into cash.
That's the logic, yeah. The value is tied right to tangible, readily available stuff. It really embodies a deep skepticism about future predictions, you know? It relies purely on current, verifiable value, a perspective probably hardened by living through tough economic times.
Makes sense. What other filters did he use to back this up?
Second big one, strong financial position. This was crucial, just making sure the business could actually survive if things get tough.
Yeah.
He looked for adequate liquidity, usually measured by a current ratio.
Current assets divided by current liabilities.
Right. He wanted that ratio to be at least 1.5, often preferred 2.0. It just shows the company has plenty of liquid assets to cover its short-term bills.
A healthy cushion.
Yep. And manageable debt. For industrial companies, he preferred total debt not to be more than net current assets, or maybe no more than 110% of current assets. For utilities, because they have more stable revenues, he allowed debt up to twice the stock equity.
Keeping debt from becoming like an existential threat.
Exactly. Third, earnings stability and modest growth. He wasn't chasing hypergrowth stocks. He wanted evidence of a resilient business model. He demanded consistent profitability, positive earnings per share, EPS.
Profit per share? Yeah.
Positive EPS for at least the last 5, sometimes 10 years, with absolutely no deficits, no losses in that period. And modest growth, maybe EPS being at least a third higher than it was 5 years before. He was pretty cautious about relying too much on earnings trends if there wasn't solid underlying value support. He preferred a stable history.
Just steady profits year after year, dependable.
Precisely. Fourth, a reliable dividend record. He really favored companies that were currently paying dividends and ideally had a history of paying them continuously.
Why dividends?
Well, it signaled financial health, for one, and a willingness to actually share profits with the owners, the shareholders. Plus, it gave you some return while you were waiting for the market price to eventually catch up to the real value.
Okay, so putting it all together, these quantitative filters,
Yeah.
they weren't just about finding stocks that looked cheap on a spreadsheet.
No, not at all. They were specifically designed to find resilient, fundamentally sound businesses, but at cheap prices. The strong financials, the stable earnings, the dividends, they all pointed towards survivability. So the margin of safety in the price was layered on top of a margin of safety in the underlying business quality. Not necessarily an amazing business, but average or better, as he put it.
Layered protection.
Exactly. And that layered protection was vital for his main goal, capital preservation, especially after the trauma of the Depression.
And these filters, they led to pretty concrete checklists, didn't they? Like the ones he suggested for a defensive investor.
Exactly. For a defensive investor, the sources mention criteria like an average or better quality rating, debt to current assets less than 1.10, current ratio over 1.50, consistent positive EPS with some growth, PE of 9.0 or less, though maybe up to 15 sometimes, PBV less than 1.20, maybe up to 1.5, and currently paying dividends. These were his systematic screens, his way of filtering the market.
Those provide really concrete, testable criteria that you can actually apply. A clear set of requirements.
Yeah, it makes the whole process discipline repeatable.
Okay, so we've got the worldview, we've got the filters. Where did the underlying thinking come from? The intellectual foundations, the DNA of this system.
Right.
Pillar 3, the intellectual lineage. It wasn't just finance, right?
No, far from it. Graham's framework drew really deeply from other disciplines, most prominently Stoic philosophy. He himself famously said he embraced Stoicism as a gospel sent to him from heaven.
Wow. That's a really strong statement. How did Stoicism actually show up in his investment approach?
Well, key Stoic ideas are clearly visible. Emotional discipline and the dichotomy of control, for instance. Stoicism teaches you to focus your energy on what you can control, like your own judgments, your own actions, your own analysis,
Okay.
while accepting what you cannot control, like external market events, other people's opinions, their moods, Mr. Market again.
Right.
This lines up perfectly with Graham saying the investor's biggest problem is usually himself, his own emotions. The goal was unruffled serenity, even when the market was chaotic.
Just ignore the noise, focus on your own process.
Exactly. And rationality over emotion. Stoicism really emphasizes logic and calmness as your guides in complex situations. That fits perfectly with Graham's insistence on thorough analysis and avoiding impulsive reactions to market swings. This Stoic foundation, it provided the psychological and behavioral framework. It's what enabled him to actually execute his contrarian strategy.
Oh, so.
Well, identifying a cheap stock is one thing, right? But having the mental strength to actually buy it when everyone else is panicking, that requires that philosophical anchor. It helps you control your actions, ignore the herd, and trust your own analysis.
So the philosophy actually empowered the methodology.
Yeah.
Made it possible to act. What else shaped his thinking?
His strong background in mathematics and logic, he graduated from Columbia, high honors in math and philosophy. This rigorous training, it led directly to his emphasis on quantitative rigor, the precise use of ratios, formulas, clear definitions, and security analysis. It also fueled his desire for a systematic approach. He was trying to make security analysis into a methodical, almost scientific discipline, rather than just speculative guesswork.
Bringing structure and numbers to what was often seen as more of an art form back then.
Kind of, yeah. And finally, classical business principles. He deeply believed that investment is most intelligent when it is most businesslike.
Businesslike? What did that mean to him?
It meant viewing a stock not just as some ticker symbol flashing on a screen, but as a proportional ownership stake in a real, actual operating business. The focus should always be on the business's fundamental reality, its true financial condition, its earning power. His personal history, too. His father's failed business, his mother's poor speculation that reinforced this conservative business owner mindset. Prioritize asset protection, a tangible reality, not abstract market theories. It provided a crucial anchor against speculative bubbles.
So investing wasn't just financial theory or math for him. It was deeply human. It required that philosophical grounding to navigate all the psychological pitfalls. Understanding this intellectual lineage matters for you because it really reveals the full architecture of his thinking, how all these different disciplines came together to create his unique system.
Yeah, it shows the depth of the foundation he built.
Okay, so we've covered the worldview, the filters, the intellectual lineage. Together, these created what you called the temperament engine. How did this whole system actually work to shape Graham's temperament, to make him capable of those often counterintuitive actions?
Right, the temperament engine. This is where the abstract principles really translate into practical behavior, especially when the pressure is on.
How does Mr. Market fit into this engine? How does that allegory function?
Well, the Mr. Market allegory, it's much more than just a nice story. It's actually powerful behavioral coaching. It trains you to detach emotionally from price swings by explicitly framing them as just moods, right? Not fundamental reality.
Yeah.
It encourages you to actively profit from market folly rather than getting swept up in it yourself. Buy when Mr. Market is irrationally depressed. Maybe think about selling when he's euphoric and overpaying. Crucially, it constantly redirects your focus away from the volatile price and back to the underlying business's actual performance and its value.
So it reframes volatility, turns it from a threat into a potential opportunity.
Exactly. The margin of safety principle also acts as a powerful discipline enforcer. Think about it. If you insist on buying a dollar for 50 cents, you are automatically forced to be patient. You simply cannot chase momentum stocks or get caught up in hype if you're anchored to waiting for that significant discount to intrinsic value.
Right.
It compels you to wait for those extreme mispricings, which often only show up during times of market panic or widespread distress.
Waiting for the fat pitch, as they say, not swinging at everything that comes by.
Exactly. Then, the Stoic underpinnings we talked about, they provide that essential psychological armor, that philosophical commitment to rationality, to emotional control. It reinforces your ability to act against the herd instinct. Your focus shifts inward, trusting your own meticulous analysis, your own process, rather than being swayed by popular opinion or fear.
Trusting your own work even when the whole world seems to be screaming the opposite. That takes guts.
It does. And finally, the systematic rules, those non-negotiable filters we discussed, they provide a concrete, almost mechanical checklist. They function like guardrails that can help override your emotional impulses. By committing to stick to a predefined formula, as one source notes, those counterintuitive actions like buying during a crash, they feel less like reckless gambling.
Yeah.
And more like logical steps within a rational pre-agreed plan.
This feels like the absolute heart of it. Putting principles into practice when it's hardest. It's really about engineering your own behavior when your emotions just want to take the wheel.
It really is. Designing your response to the market, not just reacting to it.
Okay, let's see. This temperament engine, this whole system put to the test. Let's look at a real-world example. The GEICO investment. It's absolutely legendary in value investing circles. How did Graham's system guide him there? And were there moments where maybe he bent the rules?
The GEICO case. It's fascinating because it reveals both the power of his system and, perhaps surprisingly, its inherent flexibility, at least under truly exceptional circumstances.
Okay, set the scene for us. What was happening?
Right. It's 1948. Graham Newman Corporation invests $712,000, a fair bit of money, then to acquire 50% of GEICO. Now, at the time, GEICO was a relatively small auto insurer, but it had this innovative, low-cost, direct-to-consumer model.
Different from the rest.
Very different. Meanwhile, the broader insurance industry was actually facing significant losses because of post-war inflation.
So, opportunity and distress. Applying Pillar 1, the worldview. Seeing opportunity where others saw problems.
Absolutely. Graham saw an opportunity where others just saw industry-wide trouble. He recognized that GEICO's unique low-cost model gave it a powerful, durable, competitive advantage. An advantage that Mr. Market, being pessimistic about the whole industry, was failing to fully appreciate.
Okay, so how did Pillar 2, the filters like the margin of safety, come into play here?
Well, the initial purchase price was actually at about a 10% discount to book value. Now, by some of his strictest deep value standards, the net nets and cigar butts, that might have seemed like a pretty modest margin of safety.
Only 10%.
Yeah. However, and this is the really crucial point, the quality and the growth potential of that underlying book value, driven by GEICO's superior business model and its super efficient operations, that was profoundly underestimated by the market. GEICO was exceptionally profitable. Its underwriting profits were way better than the struggling industry average.
Ah, so the margin of safety wasn't just in the numerical discount to book value, but maybe in the hidden strength and growth potential of the asset itself.
Precisely. And here's where it gets really interesting and reveals the nuances of the system. Graham conspicuously bent, or maybe even outright broke, some of his own cardinal rules for this one investment.
Ooh, like what?
He committed nearly 25% of his partnership's total capital to GEICO.
25%.
Yeah. That's a dramatic deviation from his usual stated practice, which was limiting any single stock holding to no more than 5% of the portfolio.
25% versus 5%.
Yeah.
That's an enormous bet for someone focused on safety.
It absolutely was. And furthermore, Graham apparently had a well-known, long-held disdain for insurance company investments, so the very choice of industry was an exception for him.
Okay, so the quantitative rules, those filters, specifically the diversification one, were basically set aside here. What drove him to do that? Why deviate so much?
Well, this points back to Pillar 3, the intellectual lineage, and the power of that temperament engine. While the initial valuation definitely involved quantitative analysis, the decision to concentrate so heavily and to override his typical industry aversion, it strongly suggests a deep, business-like qualitative assessment.
looking beyond just the numbers.
Exactly. Assessing GEICO's unique model, its sustainable advantages, the quality of its management, Graham clearly had the conviction, the fortitude, to make a large, highly contrarian bet on what he saw as a truly exceptional fat pitch opportunity, even if it meant deviating from his own established rules.
So he trusted his deep business judgment, his own analysis over his standard quantitative constraints in this specific extraordinary case.
That really seems to be the key lesson here. And the outcome, of course, well, it was spectacular. That initial $712,000 investment, it grew to over $400 million in 25 years.
Wow.
A return that Graham himself later noted, maybe a bit ironically, actually exceeded all the other profits from his partnership combined.
That's just incredible. So what's the big takeaway from the GEICO story then?
The GEICO investment, it's incredibly instructive. It suggests Graham's rigorous system wasn't entirely rigid. His deep qualitative assessment of a unique, superior business model and management could, in truly exceptional circumstances, lead him to deviate from his standard quantitative rules, even on core principles like diversification limits. It shows there was this latent flexibility, maybe an enterprising investor capability hidden within his framework. It wasn't just about robotically applying formulas. It was also about recognizing a superior business model available at a reasonable price with enormous potential. And paradoxically, this huge success also highlights the potential opportunity cost of over-diversifying. If you genuinely have the ability to spot truly exceptional businesses, a lesson his most famous disciple, Warren Buffett, certainly took to heart.
So even the master wasn't a purely rigid machine. It really forces you to consider that balance, doesn't it?
Yeah.
Between sticking to a system and knowing when to recognize something truly exceptional.
Yeah, it highlights the art that definitely exists alongside the science in investing.
Okay, now let's flip the coin. Let's look at the anti-portfolio. What famous, successful companies might Graham's system have just missed entirely? And what does that tell us about its inherent limitations?
Right. A classic example the sources bring up, and it's a quintessential case, would be a high-growth, market-dominant technology company during its prime. Think about IBM in the 1960s.
The original tech giant, Big Blue.
Exactly. Throughout the 1960s, IBM was just experiencing phenomenal growth, often 15-20% a year. It commanded this massive 70% market share in computing. It was the absolute definition of a growth stock for that era.
Okay, so how would IBM have fared against Graham's Pillar 2 filters, his quantitative rules?
Oh, almost certainly screened out immediately. IBM would have traded at very high price-to-earnings multiples, high PE ratios, and high price-to-book multiples, PB, reflecting that incredible growth rate and market dominance, right?
Yeah.
These valuations would have just blown past Graham's preferred limits, like a PE under 15 or a PB under 1.5. Graham was typically looking for statistically cheap stocks, companies trading way below their intrinsic value based on existing assets and earnings, not market leaders trading at premium valuations based on future growth expectations.
So simply failing the cheap price requirement would have been enough to rule it out.
Yes, in most cases. And this failure, when looking at IBM, it reveals several inherent limitations or maybe blind spots in Graham's model. Not necessarily errors within his system for its time, mind you,
Okay.
but rather consequences of its fundamental design.
What kind of blind spots are we talking about?
Well, first, a blind spot for sustained high-growth compounders. His system, heavily anchored as it was to current assets and historical earnings power, it just wasn't optimally designed to value companies whose primary asset was future growth potential or intangible technological leadership.
Right.
It was excellent at finding undervalued assets or betting on things returning to the average, but it was less suited to identifying and capturing that explosive, long-term compounding growth that's fueled by innovation and market dominance. This is a major reason why disciples like Warren Buffett evolved their approach, shifting towards recognizing that buying a truly great business at a fair price can often be better than buying a merely fair business at a great price.
The system was really built for a different kind of business, a different market environment, maybe.
It was optimized for conservatism, yeah. Second, an emphasis on tangible assets. Graham's valuation methods, especially book value and net current assets, relied heavily on physical assets, things you could see and count on a balance sheet.
Stuff you could touch.
Exactly. For a company like IBM, whose value was increasingly tied up in intellectual property, its brand recognition, its installed user base, ongoing innovation, mostly intangible assets, his framework might have systematically undervalued it, or just deemed its price too speculative because the value wasn't tied to concrete, tangible stuff. Valuing intangibles is, of course, an even bigger challenge today.
Yeah, his tools just weren't really designed to capture that type of modern value creation.
Exactly. Third, a deep-seated risk aversion to expensive stocks. Even though IBM's earnings were strong and growing really rapidly, its high market price relative to its current earnings and book value, it likely wouldn't have met his stringent margin of safety requirement in price. He was just fundamentally wary of paying a high premium for future growth that was already baked into the stock price.
Okay, so the system was optimized for capital preservation, for downside protection, and that necessarily meant consciously accepting the trade-off, potentially missing certain types of high-growth companies that just didn't fit his low-price criteria.
That's precisely it. The design parameters meant accepting missing some winners to avoid potentially more numerous losers. Buffett and Munger have both openly talked about Graham's insufficient emphasis on evaluating future growth potential.
Understanding what Graham's system doesn't capture is just as crucial as understanding what it does. It's essential for knowing its limits, and maybe how to adapt its core principles for today's markets. No system is perfect, right?
Absolutely. Knowing the boundaries is key to applying it wisely.
Okay, that leads us right to the biggest challenge then.
Yeah.
Where does Graham's strategy show? Well, brittleness. Where does it struggle for relevance in modern markets, especially with all the technological shifts and different economic environments we see now? Where might a strict Graham approach consistently underperform today?
Yeah, several key areas really stand out. First, secular bull markets driven by intangible assets and high growth expectations. Think about market environments where the dominant leaders have minimal physical assets, but massive value tied up in things like intellectual property, network effects, proprietary data.
So, many modern tech giants.
Exactly. They fit this description. Graham's traditional tools just struggle here. His reliance on low price-to-book ratios, focusing on tangible assets, his skepticism of high PE multiples. It systematically filters out many of the market's biggest winners in these periods. His framework has a hard time valuing these asset-light business models. It struggles to differentiate between, say, speculative froth and genuine, sustainable growth driven by unique advantages like network effects or data moats. His inherent conservatism just makes him averse to paying high prices for future payoffs, even when those payoffs ultimately materialize in a huge way.
So his valuation methods weren't really built for businesses where the factory is basically code or the inventory is data.
Exactly. Yeah. Value creation mechanisms like network effects, platform effects, data moats, they're incredibly powerful, but they're really hard to capture neatly on a traditional balance sheet. Second big area, persistent zero or low interest rate policy environments. ZIRP or LRRP.
Right, where rates are held super low for a long time.
Yeah. Graham used bond yields as a kind of reference point, a way to calibrate what were acceptable stock valuations. In a world where central banks keep interest rates near zero for ages, a strict application of his comparative logic could imply that extraordinarily high PE ratios are actually okay, which fundamentally dilutes the core value concept, doesn't it?
It kind of breaks the comparison.
It does, and maybe more critically, authentically cheap stocks, by his absolute metrics like nets or low PB stocks, they become incredibly scarce.
Right.
Because asset prices just get broadly inflated by the low cost of capital. That traditional safety margin, that wide buffer, it's just much harder to find because the market's willing to pay a premium for almost any return above zero.
So the fundamental signals he used to figure out value get distorted when interest rates are held artificially low.
Precisely. Third, the ongoing technological shift towards asset-light, IP-heavy businesses. His core frameworks, especially the net strategy and that heavy focus on tangible book value, they're just poorly suited for companies where physical assets are minimal, where the core value lies in software, patents, brands, data networks. Book value today is often a much less reliable proxy for liquidation value or even underlying worth than it probably was in his time. While he acknowledged you needed to assess the earning power of intangibles, actually quantifying the future earning power of these rapidly scaling, often initially unprofitable, disruptive tech companies. It requires a degree of forecasting that Graham typically tried to avoid. He preferred verifiable historical data. So valuation tools like PB and NCAV, as he applied them, they lose significant relevance.
These are, well, they're the undeniable realities of today's market structure, today's economic environment. How can Graham's foundational principles still be relevant when the world has changed so drastically?
That is the critical question you have to wrestle with, isn't it?
Let's make that challenge really concrete then. Let's do a timelessness test. How would a hypothetical young Benjamin Graham, applying only his established mental models, his criteria, How would he analyze a modern, complex business like, say, Snowflake, S-N-O-W? High growth, asset-light, cloud-based, historically unprofitable.
Okay, that's an excellent simulation to run. Let's walk through exactly how his process, based purely on the sources we have, would likely unfold when looking at Snowflake's financials.
All right, start with pillar 2, the filters. How would he review the financial statements? What would jump out?
Okay, first, the balance sheet review. He'd immediately look at the current ratio, right? Measuring the company's ability to pay short-term bills with liquid assets. Snowflake's current ratio, based on recent data in the sources, is around 1.78. Now, that might just squeak past his minimum threshold of 1.5 or maybe 2.0. So perhaps neutral, slight positive there. You'd also check debt levels. Snowflake's debt to equity is around 0.75, which also seems acceptable by his standards. And here's where his tangible asset focus really bites. He would heavily discount or maybe even completely ignore goodwill and other intangible assets.
Like the non-physical stuff.
Exactly. Snowflake has significant intangibles, about $1.33 billion, compared to its total equity of about $3.01 billion. So the tangible equity, the stuff he'd really count, is much lower. This would be a major point of concern for his asset-backed value approach. Red flag number 1. Right there.
Okay, how about the income statement? Profits.
This is where it gets even clearer. He would assess earnings stability and growth. Remember, Graham demanded consistent positive earnings per share, no deficits, no losses for 5 to 10 years.
Okay, and Snowflake.
Snowflake, being a high-growth company reinvesting heavily, has a history of consistent, significant net losses. Fiscal 2024 lost $836 million. FY23 lost $797 million. FY22 lost $680 million. This history of big net losses. It's an immediate and substantial red flag. A core requirement just being profitable is absolutely not met.
Clear failure on a really fundamental profit requirement. And dividends. Does Snowflake pay any?
He favored a reliable dividend record, right? Sign of health, shareholder alignment. Snowflake does not pay dividends. Now, that's common for growth companies, but it would be another negative mark in Graham's system.
Okay, so the fundamental business quality filters, especially on earnings, are failing pretty badly. How about the valuation metrics, the price-based ones?
Right. PE ratio. Graham wanted price to earnings under 15, ideally under 9. With negative earnings, Snowflake's PE is, well, it's undefined or effectively infinitely high. Clear fail.
PB ratio, price to book.
He looked for PB under 1.5. Snowflake's market cap is around $48 billion compared to its book value of roughly $3 billion. That gives a PB around 16 times. And if you use tangible book value, which you would, it's even higher. This is just a massive deviation from his target. A clear fail.
And what about that Graham number concept we mentioned earlier?
That formula uses earnings per share. With negative EPS, it's either undefined or the formula spits out a value of 0. So there would be no acceptable price for Snowflake according to his formula. Definitive fail.
And the all-important margin of safety, where does that leave us?
Well, based on his quantitative methods, the consistent negative earnings, the extremely high valuation relative to both book value and especially the business's tangible assets, its asset-light nature, Graham would almost certainly conclude there is absolutely no discernible margin of safety. 0. He would almost certainly classify any investment in Snowflake as highly speculative, not an investment by his definition.
So what would be his probable final conclusion on Snowflake, based on his system?
Unequivocal rejection. As an investment candidate, it fails virtually every single one of his quantitative tests, whether for a defensive or an enterprising investor. Now, he might acknowledge its impressive revenue growth, sure, but he would be deeply skeptical that it could translate into the kind of sustainable, verifiable profit needed to justify its price, particularly without significant tangible asset backing. A Graham-based model score mentioned in the sources confirms this comprehensive failure.
So it's not that Benjamin Graham would necessarily, hate technology companies per se.
No, probably not.
But that Snowflake's specific financial profile, the lack of consistent profit, the reliance on intangible value, it just fundamentally doesn't fit his strict definition of an investment.
Exactly. Its profile falls squarely into what he would define as speculation, based purely on his rules. His historical, tangible-focused metrics, his requirement for demonstrated stable earnings, they simply don't align with the characteristics of a modern, intangible-driven, high-growth company that's prioritizing market share over near-term profitability. This simulation, it vividly shows which types of modern companies his system filters out and why, purely based on its original design.
And the core limitation really highlighted here seems to be its historical bias, its focus on tangible assets in a dynamic, forward-looking market where value is increasingly intangible.
That's precisely it. By the time a company like Snowflake might potentially demonstrate the kind of consistent, verifiable profitability and accumulate the tangible assets required to pass Graham's tests. Its explosive growth phase, and therefore a significant chunk of its return potential might already be over. Warren Buffett's evolution, towards focusing on great companies at fair prices, explicitly considering future growth and durable competitive advantages, or moats, that was a direct response to this limitation he saw in Graham's original framework.
This simulation really forces you, the listener, to think about the challenge, applying timeless principles to a very different world.
Yeah, it highlights that tension, doesn't it, between conservatism and capturing the potential of new business models.
Okay, so we've deconstructed Graham's system, we've tested its limits, we've even applied it to a modern example like Snowflake. What is the absolute essence of this system? If you could distill it all down, what's the core takeaway?
Right. Synthesizing everything we've talked about, Graham's system was a highly coherent, really powerful machine. Perfectly suited for its time, it was built on this rational, skeptical worldview that understood market irrationality, Mr. Market, intrinsic value, and prioritized protecting capital above all else. It was operationalized through these disciplined, quantifiable filters designed to identify verifiable bargains. And it was powered by that remarkable temperament engine, drawing strength from Stoicism, from emotional fortitude, enabling that counter-cyclical action. It absolutely excelled at finding undervalued, resilient companies and protecting investors against permanent loss of capital.
But as we've seen, it had its limits, especially looking at it from today's perspective.
Yes. It definitely shows brittleness when applied strictly to high-growth, intangible-rich businesses, and in market environments distorted by persistently low interest rates. Its reliance on historical data and tangible assets, that's its primary challenge in today's economy. But this imperfection, you could say, it's also the result of its design. It represents a conscious trade-off. Maximizing safety meant accepting the opportunity cost of missing certain types of rapid growth. It was optimized, first and foremost, for preservation.
Okay, if someone listening right now could take just one single concept from Benjamin Graham, the one thing that would be the most powerful lever for improving their own results, what is it?
Oh, without question. It has to be the margin of safety. But, and this is crucial, it's vital to understand this not merely as a calculation, not just $1 for $1.50 or 2/3 of net current asset value.
Right here.
It's a fundamental intellectual discipline. It's an operational imperative. It's the unwavering demand for a significant buffer, a cushion, between the price you pay for an asset and a conservatively estimated value you receive.
Why is that single idea the most powerful takeaway? What makes it so central?
Well, for several really profound reasons. First, it fundamentally acknowledges imperfection and uncertainty. It's basically an admission that your own analysis will be flawed sometimes. The future is inherently unpredictable. Negative surprises will inevitably happen. It provides essential room for human error.
It's like built-in protection, both against the market messing up and against yourself messing up.
Exactly. Second, it forces conservatism and patience. By demanding that significant discount, you are inherently compelled to be conservative in your valuation estimates and patient in waiting for the right price to come along. It's a natural antidote to chasing trends, to succumbing to FOMO, fear of missing out, and acting impulsively.
Yeah, it stops you from doing the dumbest things when emotions are running high.
Third, it offers a powerful dual benefit. Think about it. By buying below value, you simultaneously reduce your risk of permanent loss. That buffer protects you if your analysis is wrong, or things just go bad, and you increase your potential for gain. The return gets amplified because you bought at a discount to fair value.
Downside protection and enhanced upside potential, all wrapped up in one core principle.
Yes. Fourth, the principle itself is universally applicable in spirit, even if the specific methods of calculating value change over time or across asset classes. While Graham's specific metrics might not apply perfectly to every modern asset or business model,
Right.
the core idea of demanding a buffer against adverse outcomes is timeless.
Yeah.
Even when you're valuing a high-growth stock, the principle forces you to consider the safety. What happens if your growth assumptions are only partially right? What if the competitive landscape changes? It forces that risk assessment.
It forces you to think about risk and potential loss, even when you're excited about the growth potential.
And finally, maybe critically, it serves as a powerful psychological anchor. It gives you a rational, predefined basis for making difficult decisions. You're compelled to buy when others are gripped by fear because the margin of safety is wide. And you exercise restraint, or maybe consider selling, when euphoria reigns because the margin has disappeared or even reversed.
It's the principle you can kind of cling to when the market storm hits and everything feels chaotic.
Ultimately, the margin of safety is really an embodiment of intellectual humility in investing. It's the recognition of the limits of your own knowledge, your own forecasting abilities, the unpredictable nature of the world. And this humility, perhaps born from his hard experiences and reinforced by Stoicism, is what allows an investor to survive those market squalls long enough for the fundamental value, the weighing machine, to eventually assert itself.
That truly feels like the single most vital concept for your success as an investor.
Yeah.
Protecting you when you inevitably make mistakes.
Yeah, it's the core of moving from just speculating to actually investing.
Benjamin Graham, a true system architect. His principles, while definitely forged in a different economic era, continue to challenge and instruct us today. This deep dive, I think, reveals that the quest for investment success isn't just about predicting the future or finding the next big thing.
No.
It's also deeply about understanding human behavior, building a robust personal system for yourself, and appreciating the timeless wisdom of those who navigated the markets before us.
It really is about building your own durable framework for rational action in an often irrational world.
So here's something for you to really consider as you think about your own approach, especially when you're looking at businesses that maybe Graham's original tool struggled to evaluate. How can you integrate that timeless principle, the margin of safety, into your investing process today? How do you effectively balance that essential need for a buffer against uncertainty and potential downsides with the undeniable potential of future growth, particularly in today's market? It's an ongoing challenge, isn't it? But Graham's profound system gives us a really powerful lens through which to confront.